In today's video, we are going to discuss MassMutual's variable loan interest rate. We're going to talk about how it works, then how it affects you as a policyholder, A, when starting a policy, and then B, after you already have a policy in force. We're going to look at a couple examples. So let's get on into it and have some fun, shall we? So what I want to start with up here is actually this guy, which is very important. So it's a side note, but it's something we definitely want to have awareness on. LISR, which is MassMutual's life insurance supplement rider, and we've got premium flexibility next to it. So when we design policies for maximum cash value, I would say about 99.9% of individuals we work with are selecting this LISR rider. And the main reason why is because it gives you, the policyholder, the ability to adjust your payments annually when your premium is due without medical underwriting. Specifically, the LISR rider, which is a combination of term insurance and PUAs, I can scale my payment up, meaning I can add more funds to the PUA rider without medical underwriting on my policy anniversary date. So as an example, I can start a policy, perhaps I fund $100,000 in the first year, then years 2, 3, 4, and 5, I only pay $20,000. But then in year 6, I want to go back up to $100,000. If I don't have the LISR rider attached, I'm going to have to go through medical underwriting before MassMutual will accept my money. However, if I have the LISR rider attached, what happens? Well, I can scale the payment back up without medical underwriting. We just make the adjustment on the back end. MassMutual updates your online portal, and you can send the funds right in. In addition to that, it gives a policyholder the ability to add a large PUA payment on an annual basis for a long time without triggering a MEC. You can't always do that with a level term rider. So this is very beneficial to have on a MassMutual policy, and why it's important, because the topic of this video is MassMutual's variable loan interest rate. Here's why. The LISR rider is only available if the variable loan rate is selected. Meaning if you want the fixed loan interest rate with a MassMutual product, you cannot have that LISR rider, which means we do need to understand the lack of flexibility that will exist with your MassMutual policy. So it's very beneficial to be aware of that rider. So let's get into the variable loan rate now and describe exactly how it works. So first, we see a floor. Every whole life insurance product will have a floor, which is as low as the variable loan rate can be. And again, this is specific to your policy. That variable loan rate floor works like this. Whatever the guaranteed rate is, plus 1%. So let's go through an example here. We see different products. In blue, we see MassMutual's current products. And then in purple, we see legacy products. These represent the older MassMutual policies that had a 4% guaranteed rate that were started by individuals before the 7702 change, meaning if you purchased a policy before the year 2022, you likely have a legacy product. So let's begin up top with the Whole Life 100 product. That product has a guaranteed rate of 3.75%. So the variable loan rate floor is 4.75%. So let's assume you're starting a policy. So this is for a new policy. When you start the policy, we'll assume that MassMutual's variable loan interest rate as a company is 3%, like it was early 2022. So MassMutual's variable loan rate as a company is 3%. What is your policy loan rate if you selected the Whole Life 100 product? The floor is 4.75%, so that's your loan interest rate. Now, if we've got that 3% loan interest rate, or I should say, if that's MassMutual's loan interest rate, let's assume it is for all products, what'll happen here? Well, if you select the high yearly cash value product or any other product with a 3% guaranteed rate, you've got a variable loan rate of 4%, or I should say a variable loan rate floor of 4%. So even though the company's rate is 3%, because your floor is 4%, that's what your loan rate would be when starting a policy. Now the 15-pay product, what do we see here? Has a floor of 3.5%. Company rate is 3%. So what would happen? Your floor, 3.5%. Let's do the 10-pay a little bit different, because in this case, if you've got that variable loan rate floor of 3% and the company's rate is 3%, what'll happen when you start a policy? It'll be 3%. What if, however, the loan rate was 2.5%? What would it be? What would your rate be is my question. It'd be 3%, because that's your floor. What if, when starting a policy, the company's rate was 4.5%? What would your variable loan rate be? It'd be 4.5%. And legacy products, since I've been in the industry, the variable loan rate has always been lower than 5% when they were started. Now it's finally a bit higher than the floor of 5%, but that's their older product, which we'll hit on an example of that toward the end of this video. So back to the material on the left. That was a little bit on the variable loan rate floor. Let's go through rate adjustments and exactly how this works. So the variable loan rate adjustment, we have this 0.5% trigger, which we'll go through a couple examples of this. But then we see Moody's Corporate Bond Index, and then the insurance company, which is Mass Mutual monthly, and then a policyholder, which would be you, annually. So as a life insurance company, Mass Mutual's variable loan rate adjusts every month. We can actually see what it will be 2 months in advance in most cases, but they will declare what their variable loan rate will be for all policies every month. However, as a policyholder, you can experience an adjustment only one time per year. How that adjustment is determined is as follows. We've got this 50 basis point trigger. So if you start a policy, let's go through a brief example here, in 2022, and your loan rate is 4% when you first start. In 2023, let's assume Mass Mutual's variable loan interest rate is 4.3%. So their rate increased a little bit from when you started. That 0.3% is less than that 50 basis point trigger. So what that means for 2023, your loan rate will remain 4%. Now, let's assume in 2023, Mass Mutual's loan interest rate has increased to 4.7%. As a policyholder, your rate will now increase to 4.7%. So that 50 basis point trigger, 0.5% trigger, occurs if the increase is 0.5% or more on your anniversary date. That's when a loan rate increase will occur with a Mass Mutual policy. And this applies to all Mass Mutual policies, if they're new products or if they're old legacy products, which is good to be aware of, because for a long time, here we see cap X'd out. That was my understanding, and that was due just to conversations with individuals at Mass Mutual. However, digging through materials, documents, and seeing the actual contract language, the increase can occur annually, and that 0.5% trigger applies to all Mass Mutual products, which does make it easier because it's consistent across the board. And what's also consistent, if the LISR rider is attached, then I have to go with the variable loan interest rate. And most we work with, just about everyone, is concerned more about the funding flexibility. I know I am with policies than I am the loan interest rate. But with that said, let's look at a couple examples here. Before we do that, actually, the fixed loan interest rate. So Mass Mutual does offer a fixed loan interest rate. It is at 6%, meaning if I start a Mass Mutual policy, I elect the fixed loan interest rate. It's at 6%, and it's fixed for the life of the contract. If I go with that fixed rate, my product will function as a direct recognition policy, and Mass Mutual for several years now has actually increased the dividend rate on outstanding dollars, on loan dollars. So what I mean when I say that is if I elect to borrow and then repay my policy loan, I'll actually see the cash value higher than what it would have been as if I never touched anything in the first place. We've got other videos that demonstrate that. And then most importantly, no LISR is available if I go with the fixed loan interest rate. So a couple examples here. Let's first look at the high early cash value product, the HECV, which is a good option if I like strong upfront cash values, and I want the ability to pay into a policy for a long period of time. I can pay into the high early cash value product up until the age of 85. So let's assume that you start a policy in 2022. The company rate, meaning MassMutual's rate when you start the policy, let's pretend it's January for simplicity, is 3%. Increase, none, because you started the policy in 2022. What is your policy rate in this particular example? 4%. Company rate is 3%, but remember the floor with the high early cash value product is 4%. So we're at 4%. Let's assume the next year, 2023, rates go up. It's at 6%. Remember, I've got that 50 basis point trigger. Will it occur? The answer is yes. The increase will be 2%. And again, this applies to your policy because you're at 4%. MassMutual's company rate, 6%, which is greater than 50 basis points, greater than the trigger. So you'll experience the increase, and you're now at 6%. Let's assume the next year, rates came down a little bit. They're at 5.7%, which would be what? A decrease of 30 basis points. What would happen here? Well, your rate would drop to 5.7%. So MassMutual's language does state that for decreases to occur, it also must be at least 50 basis points, but then you'll see an additional note that reads, however, our practice has been and is currently to reduce the loan rate by whatever the reduction is. And it can go as low as whatever the floor is. So even though here the decrease was less than 50 basis points, it decreased by 0.3%, as a policyholder, I would still see that decrease occur. Now, let's follow up with the next year. Let's pretend January of 2025, the company's loan interest rate goes back up to 6%. What would happen to your policy here? There'd be no increase. And the reason why is because of that 50 basis point trigger. Because you were at 5.7%, it only increased to 6%. The company said that's not 50 basis points. You remain at 5.7%. And then let's assume something extreme happens. Rates go back down to 3.5% here. What happens in this particular case? You would go down to 3.5%. You'd be on your way down to 3.5%, but then we would hit our floor of 4%, and that would be our rate. So we can go down as low as the floor, but we can increase only if the increase is greater than 50 basis points. Let's look at another example here. We'll take a look at the 10-pay policy. So in this case, same thing. When we start a policy in 2022, company rate, 3%, your floor, 3%. Guess what? Your rate is 3%, and that's locked in for 12 months. This will occur with any MassMutual policy. Your rate can only change one time per year on your anniversary date. Even though MassMutual declares a different rate every month, the only month that we need to worry about is the month of our policy anniversary date, our premium due date. So similar example here, company's rate jumped up to 6%. So what happens? It's a 3% increase. The increase was greater than 50 basis points. So what that means, if this is your policy, you're now at 6%. Next year, what happens? Down to 5.7%, 30 basis points, which means your rate is now at 5.7%. Similar trend to the high early cash value product. What's the only difference? You've got a lower floor. So the next year, there's an increase, but it's less than 50 basis points. So you're still at 5.7%. And then if in 2026, the rate dropped to 3.5%, what would happen here? You would be at 3.5%. Still not at your floor, but you are going all the way down to what the company's rate is. If it went down to 2.5%, then your rate would be 3%, being the variable loan rate floor. Very easy to follow, right? Let's look at one example. If you've got an older policy, which would be beneficial to see. one of their legacy products, which would have started actually in 2021, but we'll just pretend for the sake of simplicity, it's consistent with the last two examples. So in this particular case, we have a loan rate floor of 5%. So what would happen here? Well, if the company rate is 3%, we'd be at 5%. What if it went up to 6%? Would we experience the increase? Yes, we would then be at 6%. What if the next year it went down to 5.7%? Would we go down? Yes, just like the last examples. Most likely. I say most likely because MassMutual can enforce that 50 basis point decrease. However, we've seen them always not enforce that. If it goes up 5.7 to 6%, what would your rate be? 5.7. And the reason why is because of that 50 basis point trigger. That's the main thing to be aware of as far as what can occur for you. And then the next year, if it went down to 3.5%, what would happen to your policy? Well, it would go down to 3.5%, you're on the elevator, but then all of a sudden you stop at floor 5 because your variable loan rate floor is 5%. I hope that made sense. But that's an overview on how variable loan interest rates work. If you have any questions, please let us know. You can leave a comment below. You can reach out to us direct if you'd like. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.